Now, how do we actually go about pricing a bond? Well, sort of this is what I meant by the task in a way being more difficult because more is known. So let's say we have a bond that has 5 years to maturity, a 10% coupon rate that is annual, which means it pays out but once per year, and a face value of 1,000. Then we can actually draw a timeline of cash flows that'll look like the one we've got right here, where we actually know what exact cash flows will occur. So this won't be like discounted cash flows with equity, where we have simply expectations about what the cash flow might be. We know that in year one, this bond is going to pay a 10% coupon. If the face value is 1,000, well, that means that 10% of 1,000 is 100. And in fact, it's going to pay that every year from year 1 to year 5. And then in year 5, it'll also pay back the principal, the face value. So the year 5 payment will actually be 1,100. Now, let's say this bond is default free, so we don't have to worry about maybe some of these cash flows not occurring. What would be the price of this bond? Well, we can't give it just yet. We actually need to know one other thing, and that is the discount rate. Now, just because cash flows are relatively certain doesn't mean that there is no time value of money, right? There's still potentially all the issues like an inflation premium, a maturity premium, liquidity premium, as well as just sort of the real risk-free rate. So in other words, there is going to be a discount rate, which is the required rate of return on this bond, and this is what is the missing piece that is going to let us value this stream of cash flows and therefore compute the value of this bond. So how do we do it? Well, there's a number of ways. We can, first of all, compute the present value of coupons using a present value of an annuity formula. Remember, in this case, we essentially have this bond. We can represent it as two parts. The first part is an annuity that pays you $100 a year for the next 5 years. And we have a formula for the present value of an annuity, which we find here. And the other part of the bond is a zero coupon bond that pays off 1,000 in 5 years. That's the repayment of the face value of the principal. And if we get these two present values and we add them up, that would be one way to get the present value of this bond. Now, another way to do it would be to break this bond up into 5 separate pieces. We could say that there's 5 zero coupon bonds, one $100 in year 1, another $100 in year 2, same in year 3, same in year 4, and 1,100 in year 5. That would be another way to value this bond, and it should produce the same answer. Now, generally, of course, the price of the bond will then be this present value, right? But interestingly, there's actually 2 prices that we should be thinking about when we talk about the pricing of bonds. The first of these, the clean or flat or the quoted price, is the price that we see without accrued interest. This is what you would see in print, but this is not the price that you would actually pay to buy the bond most of the time, because most of the time, unless it's right after a coupon date, a bond will have accrued some amount of interest that needs to be accounted for. Let's say that you're about a quarter of the way through a year, so the bond was a semi-annual bond, it paid a coupon 3 months ago. Well, that means that right now this bond technically has accumulated another 3 months of interest, and the person who is going to be willing to sell it will of course want that 3 months of interest that technically belongs to them. So that leads us to this idea of a dirty price, which is the clean price of a bond that has just paid a coupon, plus any accrued interest that has accumulated in the meantime. And this is what you will actually pay when you buy a bond. Now, how do you calculate accrued interest? Well, you take the annual coupon that the bond pays, divided by the number of payments, and multiply that by how many days have passed since the last payment over the number of days between payments. Now, if this sounds confusing, let's do an example. So let's say we've got an annual coupon bond. It has a rate of 10% paid annually, a par value of 1,000, exactly 5 years to maturity. So it just paid a coupon, or maybe it was just issued and the next coupon will be a year from now. If the required rate of return, that discount rate, remember that could be the real risk-free rate, the inflation premium, liquidity premium, maturity premium, default premium, if all that adds up to 8%, then what is the value of this bond? Well, let's look at this in two ways. Let's do this as the present value of an annuity plus the zero coupon bond that represents just the repayment of the principal in 5 years' time. That's the formula that we have here. And also let's represent this bond as a portfolio of 5 zero coupon bonds. All right, so let's calculate the present value of this bond in two ways. We'll first do it as a portfolio of zero coupon bonds, and then using the annuity plus zero coupon representing the face value method afterward. Hopefully they'll converge to the same answer. So we've got our cash flows plotted out on the timeline here. We've got years 1 through 5, cash flows of 100 occurring for the first 4 years, and in the 5th year we get our coupon of 100 and our face value repayment all at once. So if we were to visualize these as 5 separate zero coupon bonds, well, these should be their face values then, right? We've got one bond coming due in a year, face value of 100, same for years 2, 3, and 4, and in year 5 we've got a slightly bigger zero coupon bond, 1,100. And if you're wondering why we would ever find these weird sized zero coupon bonds, well, first of all, there actually is now the possibility to own fractional shares of financial assets, so you could potentially create such a tiny bond with an arbitrary face value out of larger zero coupon treasuries, but also you could presumably scale up the bond that you're trying to replicate instead of scaling the treasuries down. At any rate, what is the present value of this first zero coupon bond? Well, it's going to be the cash flow divided by 1 plus the discount rate. Remember, the discount rate is 8%. And how many times do we discount it? Well, we discount it just once. In fact, let's make it a little easier on ourselves. We'll just discount it by the year index above. In fact, let's make it even a little bit easier still, and let's create a cell reference to the discount rate and refer to that. If you want a static reference in Excel, you can use $signs, so B3 will be our static reference to this 8% discount rate. So the present value of the 1 year maturity zero coupon is 92.6. We can drag this out. Here's the present values of all of the 5 zero coupons that should represent this coupon-bearing bond. And that means that the present value of the bond is going to be the sum of all of these, which is 1079.85. Good. Now remember, if these zero coupon bonds were worth, let's say, more than the price of the bond, 1079.85, you can construct an arbitrage trade where you would buy cheap and you would sell high. So you could maybe borrow at the coupon bond rate, and you would invest in the, or you would sell the zero coupons, and vice versa if the zero coupons were less, if their price was less than the coupon-bearing bond. But generally, of course, since everybody can observe these, we should expect the zero coupons that represent the bond and its respective annual coupons to actually have the same sum price as the price of the coupon-bearing bond. But now let's just check that our formula works. Remember, we can also express the same bond as the present value of an annuity plus the present value of that last zero coupon that is just the face value. So if we want a zero coupon that is just the face value, that means in year 5 we would get just 1,000. So the present value of that would be 1,000 over 1 plus our discount rate. We won't worry about the static reference because we aren't really going to change any cell references here. And we're going to discount 5 times. So this is what the repayment of principal is worth to us right now. What about the annuity? Well, the formula for that is the one that we saw in the preceding slide. It's going to be our payment, which is 100, times 1 minus 1 over 1 plus 0.08 to the 5th over 0.08. And now if we add up the present value of the annuity, the 399.27, and the present value of the principal repayment, the 650.58, we see that we get the same price of this bond, 1079.85. So whether we choose to represent this bond as a sum of zero coupons or as a sum of an annuity plus a one-time zero coupon repayment of principal, we should get the same present value. And remember, if not, then you can potentially execute an arbitrage trade where you buy the undervalued one, sell the overvalued one, because ultimately the cash flows are obviously going to be the same. These are going to be the cash flows that you get in this fixed income contract. Good. Now hopefully that makes more sense. Now, is this a clean or a dirty price? Well, in a way that's sort of a trick question, but the nice kind of trick question where there's no wrong answer. In the case of a bond that has just paid a coupon, the clean price is the dirty price because there's no accumulated interest. But in all other cases, of course, it will be different. So now let's say that we've got the same bond except 30 days have passed since the last coupon, or maybe 30 days have passed since issuance. Now what's the clean and dirty price? Well, the first thing we need to figure out is what accrued interest actually is. And to do that, we need to figure out how we will count days. Now, there's actually quite a few different conventions for calculating accrued interest. But let's say the one we're following here is actual over 360. What that means is all of these conventions essentially just determine how this fraction gets shaped. Actual over 360 means number of days that have passed since the last coupon over number of days per coupon period, assuming a 360-day year. Now this is an annual coupon bond, so with 360 days per year, the number of days between coupons is 360. If this were a semi-annual coupon bond, well, then the number of days between coupons would be 180, right? And remember, the accrued interest formula is the coupon payment over the number of times the coupons paid per year times the number of days since the last coupon over the number of days between coupons. And if we plug these numbers in, this gives us $8.33 in accrued interest over these last 30 days. Now we know what this bond was worth 30 days ago, right? We computed what its present value is. If this bond has literally just 5 years to go, it was just issued or has just paid a coupon, the result in the previous example means this bond is worth $1,079.95. Now, how do we get what the sort of all-in, including accrued interest, price of this bond is? Well, one simple way to do it is to say we know what it was worth 30 days ago, and we know what the required rate of return on this bond is. Remember, the yield, the required rate of return, is 8%. So we can just say that we'll take what the bond was worth 30 days ago, we'll grow it at 8% per year, except, of course, we're not going to grow it for a whole year, we're just going to grow it for these 30 days out of a 360-day year. So that means that we're going to grow it for 1/12. And if we do that, we get a dirty price of a bond that is $1,086.90. Now, what's the clean price of this bond? Remember, the dirty price is clean plus accrued interest. Well, that means that the clean is dirty price minus accrued interest. So if the dirty price of the bond 30 days after the last coupon was paid is 1086.90, we subtract 8.33 in accrued interest, and it gets us a clean price of 1078.57. So now we know how to calculate the clean price, the dirty price, and we know when these two are equal, but we recognize that most of the time they're not going to be. Now that said, to make our lives in this set of lectures easier, going forward, we're going to assume that for all examples and questions, a coupon was just paid. In other words, we're always going to compute the clean price. But it's very helpful to remember what the definitions are, what a dirty price actually is, because in the real world, you'll have to deal with situations where that may not necessarily be the case.